investors are now fueling the AI machine, buying semiconductor and software stocks for 80 times future earnings. In times of macroeconomic pressure, this is a risk. Tangible, cash-first assets are going to be what differentiates you from the herd. What I'm recommending today is a list of 8 non-AI stocks plotted in a 2x2 risk-return matrix that will serve you for true generational wealth that is able to sustain potential stagflation and higher interest rates. Let's audit. Hello, fellow wealth seekers! We start with the first quadrant, low volatility, stable return. Here we're tracking EUR overnight rate and iShares government bonds. We're looking at stable assets that yield a 3% return by tracking the ECB's interest rate. No corporate risk, no duration risk, early maturity at 3 years max, and here you are watching other equities bleed while you bang on these liquidity anchors. Top left quadrant, your shield. Contained volatility, but higher upside due to the current inflation and supply chain breaks. The first is gold, the second infrastructure, because the first is able to shield you from when the banks will eventually debase currencies by having this unprintable classic asset. The latter, infrastructure, we're talking toll roads, airports, energy pipeline companies, are physically contracted with inflation. So the moment rates go up, their returns and yields will also go up, mathematically around 4.5%. Given the current conditions in 2026, these have a higher yield than the first quadrant. Let's move below, where the real money making happens. Higher volatility, but massive cash flow returns. Number 1 here is global energy producers. Number 2, small cap European companies. The first, simply with the geopolitical situation and the constant supply constraints, these are valued at a P ratio of 11 and yield a return that is mathematically not below 5%, a must-have. While European small cap, simply because they are aggressively, brutally very low rated in 2026. The upside is statistically better than the downside. The P ratio is at 10 and returns still fluctuate between 4 and 6 or 7%. Have to be exposed. And the last quadrant, higher volatility but lower returns. Why would we even invest here? Because we have to be strategic. Higher volatility is only on paper for these 2 I'm about to give you. Number 1, emerging markets excluding China. China is in some sort of a death spiral between demographic and real estate crisis. India and Latin America, booming, middle class expanding, real GDP power. Latter is healthcare, global healthcare distribution. The population is mathematically aging with newborn crisis in multiple countries around the world. Medicine has a completely inelastic demand. We have to be invested because the returns are mathematical. In a world of extreme volatility and a lot of AI concentration, we're talking 40% of the S&P 500 right now, we need to be diversified and strategic. If you want one broker that only has non-AI exposure and that you can leverage over the years, this is my strategy in essence. You anchor with bonds, you shield with physical, you extract cash from energy, and you grow long-term from demographics and medicine. It feels like a very solid coverage. Audit your portfolio today. Do you have assets that produce real value at least over a portion of your allocation? I hope this was helpful. Until the next session, European Wealth Lab out.